covering topics such as why should we look at private markets, private equity fund management and value creation, COVID-19 vaccination rollout, the impact on private equity and real estate value drivers and risks. We'll follow that with the question and answer session.
Next slide. So this concludes on one of the themes we want to talk about: vaccine recovery and reflation, which is going on right now, has been going on since starting in September. Is that you need to broaden your portfolio allocation in equities outside just technology, which we were overweight, but into some of the cyclical areas of the market as we have a gradual recovery, as well as small mid caps, non-US equity, as well as base metals and other economically geared assets. And this is where the asset price inflation is done and is happening right now. Next slide. So where can you snip out some yield in public markets? You can see in the bond side on the left-hand side, Asian high yield, but very selected because these are levered balance sheets. This fallen angels, these are companies that used to be investment grade, but they get ejected from an index. There are forced sellers from investment grade managers that creates opportunities. REITs, we like real estate, in some other areas. And of course, equity, Straight Times Index has a 4% yield. FTSE has a nearly 4% yield. Hang Seng 3%, etc. So you need to look to the equity market also for dividend yield, but it will be with higher volatility. The key challenge is how you build a 60-40 portfolio. There's no magic bullet to replace the fixed income portion. We are increasing, and we've been overweight private equity, real estate, infrastructure, alternatives. This is an asset allocation showing if you add these asset classes to your portfolio mix, you raise return, and you also raise your risk-adjusted return. Yes, there's an illiquidity risk, but that turns into higher returns. And if you think about the world we're living in, secularly low rates, aging population, that means rates will be lower for longer, even with bouts of them going up. You need to increase your allocation to alternatives structurally over time. And equities, which have done very well, will always also prove a very important role. But over time, you do get paid, and private markets and private market managers who are skilled can outperform handily global equity indices.
Look historically, most of the post-crisis or crisis vintages have outperformed, because of the opportunities that present themselves. Look, in the end, it's ultimately important to be invested with managers who have an experienced bench of professionals, but even more, that they've been cycle tested. They've been around stewardship of their companies that they invest in, that they have driven the value add during challenging times, or been able to pick up the right companies during those times to provide for the strong return. They underwrite the value add that they're able to contribute and the operational improvements that they're able to implement to reach the exit when they sell. And they have to provide for returns that accrue to those in the few years that they own the companies. So there's a sort of inherent discipline built into the deals that they do manage to complete on.
As far as private equity goes, when we look at portfolios, we believe that there are higher valuations as well on the private side. But when you look at recent IPO performance of listings, you do see very strong returns post-IPO, which does suggest that there's still significant public market premium. So the value of private equity in a market like that is the ability to enter before that premium is established, boosting out.
Look to find and forge the right partnerships on ground in every market that we choose to operate in. This element becomes that much more crucial and critical in times like these, especially when the ability to travel becomes highly curtailed. So these partnerships effectively are our eyes and ears on the ground.
I think one of the other areas in terms of opportunity and risk is clearly retail is an area we've shied away from as a structural issue, but leisure, and when travel comes back, will it be 2024, 2025 in terms of where we were before? It's an open question. But the capital structures of many of those assets in the hotel leisure space may not survive that kind of time period. Hence, there will be opportunistic opportunities in the leisure space in this cycle. So that's another area that's much more, a little bit shorter term, more opportunistic, but where there's going to be some pretty solid IRRs if you can find the right opportunities.
In the current environment, real estate potentially offers opportunistic entry points, but with defensive and uncorrelated income return in the medium and long term. And that is essentially, an enormously attractive proposition in times of uncertainty. And I think that's the reason, that's the main reason I believe, you remain invested through these times as well.
Look, in a crisis or post-crisis scenario, certainly distressed funds will do well. There's a much wider range of opportunities, subsets for them to choose from, where they pick up challenge companies that need to be turned around. But equally, opportunistic funds which provide liquidity for corporates will obviously be in vogue. And these two strategies will certainly do and have. Look at Moonfare, we've onboarded, continued to onboard many different strategies, but within the credit space, we've noticed that there's a range of opportunities. So we've onboarded a manager that almost has a dual strategy, has the ability to still do credit equity to take advantage of any upsides that occur, but then it is strong in distressed credits.
And just to conclude, so we've had some risks that fade away, like Brexit, like US elections, and clearly we at least have a vaccine now. We have to see its efficacy. But this 60-40 portfolio role and how you position for that is extremely important. And the relevance in private investments and alternative investments are very important in that regard.